It's a great pleasure to be here, guys. It's like playing a home game. I've been in London now for the last couple of years. My background is checkered. I've got a degree in engineering. I've got an MSc in metallurgy. I've got a PhD in mathematics. All of which, I assure you, is largely useless in taking money out of markets regularly and consistently. And what I want to try and get across in a few minutes is how to go about putting together the mental framework to be able to take money out of markets consistently and get yourself to a point where you can rely on that income in the same way as you can rely on your salary or the income that you draw from your business. So that's the objective. Now, when I do this seminar at the banks, and I've done it for all the local banks here, and I've done it for most of the banks in London, it takes 3 days, and I'm going to try and do it in the next 40 minutes. Okay? I've got a lot of slides, and I probably won't get through all of the slides, but I'm sure that the guys at Funport will send you the presentation if you wish. Okay? My association with the company is that the founder, Vussi, I don't know where he is, but the founder of Vussi and I have been doing business together since he was 30 minutes old. And it doesn't seem that long since he was shouting at me when I was actually going to my office in Ravonia. He used to shout at me and said, "Kit Kat," because he wanted me to bring a Kit Kat home that evening. So any of the Funport people listening, if you want to bribe the boss, just buy him a Kit Kat. The thing that stood me in best stead in markets is that in my youth I was an officer in the Royal Marines. And that's given me a level of confidence and discipline that I've drawn upon for a very long time. And 42 years later I can still fit into the uniform. As anybody who feels like having a go can have a go, I assure you. I've only got one regret in life, and that one regret is that if I was 35 years younger, I'd be a professional rugby player today, because I came to South Africa to play rugby. That's why I came here in the first place, and got an injury from it. But I think if I was 35 years younger, I'd be a professional rugby player. So I'm not that good with contraptions, so I'll do my best to make the slides work. Yes, so Barry talked about an edge. I'm going to try and talk about an edge. My edge is very similar to what these gentlemen have just presented. I like to put the fundamentals and the technicals together in the stock market. My definition of fundamental analysis is the search for the true value of a share. My definition of technical analysis is the study of trends and turning points. And ladies and gentlemen, I want to try and find a share that's undervalued, a share that's growing its earnings aggressively, reasonably safely, that's rising, that's in the throes of a strong trend, and ladies and gentlemen, I want to buy that when the general market is rising. Okay? And that's what I've been doing for a very long time. I do my best to stick to that. Those of you that have been trading for a while will know that sticking to a simple set of trading rules is an awful lot easier to talk about than to do. Am I correct?
Yeah.
Okay? And as if there's little devils on your shoulders shouting at you to do the wrong thing. So, to make some money in markets, folks, we need some form of a method. Yes? We need to manage our money really well. And we need to manage ourselves really well. The 3 M's. So, I'm going to talk about a methodology. So, I'm going to ask you a question. Did they put that chart in? There we go. There's the Aussie 40, I think I asked them to put in. And my question to you, that's the MACD. I know the guy who put the MACD together, a good friend of mine, a guy called Jerry Appel, and he said that when he designed the MACD, an axiom of investment education is the more complicated it sounds, the more you can sell it for. And he thought that MACD was suitably complicated. That's why it's called the moving average converging diverging. Jerry Appel and his 2 sons have got more money under management than Investec, just the 3 of them. And a little room in a place called Derry, Maine. Stephen King writes his books just across the road. Is the JSE going to go up or down on Monday? My question to you. What do you think?
Down.
Down? Young man says down. Any other? Bradley, what do you think? You're the expert. Up? Well, folks, in my pocket, I have the secret. If I can find it. I have the secret. It's a 5 rand coin. Now, on one side, there's a furry little animal. You see that? And on the other side, we've got a coat of arms. Clearly, the coat of arms is going up, and the furry little animal is going down. Let's see if I can get this right. You were right. The head, it's going up. Okay? Would you trade like that? No. Okay. But I assure you, most of you are trading like that already. There's a great deal of randomness out there, I assure you. But I wouldn't like to trade like that either. So, my next question to you. Let's play and think about a special game. So, here's the game. If you can successfully predict heads or tails, and you're correct, if you bet 5 rand and you're correct, I'll give you 10 back. Clearly, if you're incorrect in your prognosis, I'm going to take the 5. Now, you've already said that you wouldn't trade with the coin, but would you play that game? Ladies and gentlemen, that's my question to you. Would you play that game? Yes or no? Well, folks, I haven't got a lot of time to play this out. It's a cracking game to play. And it's the basis of how you can become consistent and take money from somebody else, because that's what you're doing. Because in 10 chucks of the coin, would you agree that you should be right 50% of the time? Yeah? Now, when you're right, I'm going to pay you twice as much as when you're wrong. So in 10 throws of the coin, when you're right, I'm going to pay you 5 times 2, which is 10. Yes? And when you're wrong, I'm going to remove 5 times 1, which is 5. Thus, you make 10, you make 5 profit. If you bet a rand on every time you chuck the coin in the air, on average, you're going to make 50 cents. You have now designed a positive expectancy system. So if you can find somebody to underwrite that, then Barry, that's your edge. Okay. And that is the objective, folks. Now, with the Finport guys, with GT, you should be able to get your hit rate above 50%. But if you can be right 50% of the time, and you can make twice as much when you're right as you lose when you're wrong, then you've got a method of making money for the rest of your days. And that is the challenge, to learn how to play the game over and over and over again without fear or hesitation. Okay, so it's a cracking game to play. Would you play the game? Now, in trading, the number of times that you're right is called the hit rate. And Lord only knows we're all paranoid about the hit rate. We want to be right at all costs. There are 4 trading fears. 1 is being wrong, 2 is losing money, 3 is missing out, and 4 is leaving money on the table. Those of you that are under 50 are probably in a safe place, because I know for a fact that most men over 50 are more scared of being wrong and losing money than they are of death. Okay? Am I correct? We've got the death thing all sorted out. Well, it's not the end of the world, okay? But to be wrong or lose money is an issue. So, that other thing that's important in trading is the risk to reward ratio. So the money that you make is a function of both the hit rate and the risk to reward, and most of us just think about the hit rate. So 3 things. Now, if you do a search on the internet, if that's a margin call, don't take it, okay? Just don't take it. Just ignore it completely. A margin call is what happens, folks, when you run out of loot. And the lads from GT are going to phone you here and say, more money, or we close the whole bloody lot. Okay. So if you get a call, just don't take it. If you do a search on the internet, you're going to find lots and lots of systems where the vendor says that you're right 92% of the time. And they all sound wonderful. But the problem with those systems is that they've got to open up their stop losses so wide in relation to their targets that they don't make any money. And this was brought home to me a few weeks ago. And this is a chap in London who was advertising a Forex system. Somebody spoke about Forex, and he said he's right 90% of the time. Sounds wonderful, doesn't it? But when he was right, in his own literature he said this, when he was right he makes 10 ticks, and when he's wrong he loses 90. What's the expectancy of that system? 9 times 10 when he's right, minus 1 times 90 when he's wrong, and that means the system actually loses money. Sounds wonderful 90% of the time, but he loses money. So folks, just remember that edge is a mixture of 3 things. It's a mixture of the hit rate, it's a mixture of the risk to reward, and the commissions. And there's no doubt that if you're trying to scalp a 1-minute chart, you need to be really, really good, because those commissions mount up. Every time you press the wee button, there's 3 or 4 ticks to be paid. And that's hit rate, risk reward, and commissions. So folks, somebody mentioned the Forex market. If you buy the pound against the dollar with a 50-point stop and the target's 100 points, if you can get that right 50% of the time, you've got it made. And the only thing remaining is to learn how to play the game. And it is a game that we play with ourselves. And playing the game is the tough bit. Now, I want you to use your wonderful imagination. Because in this vessel, we have 100 1-rand coins. Yeah? You see them? Right? Now, on every decision, on every trade, there's 2 decisions. One, is the damn thing going to go up or is the darn thing going to go down? Now, Barry alluded to the concept of going short, which might be new to some of you, but you can take a bet that the market's going to fall. And if it does fall, you're going to make some money. So, that's the first decision. So, the man in the green, heads or tails? Tails. The market's going to fall. The bear in the green. We've got 100 coins. The second decision, ladies and gentlemen, is how much do you want to bet? You can bet 1 coin. You can bet 5 coins. Or in the parlance of the commodity futures market, you can bet the farm, the whole bloody lot. Farmers love betting the farm. Okay. So the man in the green says the market's going to fall. Tails. How many would you like to bet, madam? 1, 5, 20, 75? 20. Okay. So let's trade. What we're doing is that we're simulating a trading system that's right 50% of the time, that makes us twice as much when it's right as it loses when it's wrong. I assure you that if you were a day trader in the Forex market, you would sell your granny for that system. Okay? Your granny. Because most intraday systems will risk 30 to make 50. And if the vendor is honest, it's not right that much more than 50% of the time. So, the man in the green, are you feeling lucky, lad? Okay, don't take it too personally now. That's not a great throw. Not a great throw. Pound coined is much easier. Sorry, mate. It's going up. You lost. Sorry. No, he bet. He bet it was going to go down. So 20 gone, and we've got 80 left. The man in the red. Heads or tails? You, sir. You'll never wear that red pullover again. Heads or tails? Pardon? Heads. We've got 80 coins left. The man with a cold head with a cap on. Remember John Wayne's last movie? He said to the guy coming in, he said, "Is your head cold?" He's still wearing the hat himself. We've got 80 coins left. How many would you like to bet? Pardon? 40, he says. Okay. This trade is totally independent of any other trade that you're ever going to take in your life. This is the first of the 10,000 trades that you're going to take between now and death. You said heads, hey man? Let's see if I can get this right. That's an awful throw. Pound is much easier. That's better. Heads is correct. So we get 80. 80 and 80's 160. We're ahead of the game. Now folks, the man in the red was lucky, unfortunately. What's the probability of a bad one? A half. Now, what's the probability of 2 bad ones in a row? A quarter, half times a half, which is a quarter. Now, in a 50% system, unfortunately, you get 2 bad ones every 4 trades. Ladies and gentlemen, if you were to bet 50% of your coins on any one trade, you go bankrupt every 4. Do you understand that? Gets worse. What's the probability of 3 bad ones in a row in a 50% game? A half times a half times a half, which is 1/8. That means throw a few coins when you get home. That means that in 8 throws of the coin, or 8 trades in a 50% system, you have a cluster of 3 bad ones in a row. That means, ladies and gentlemen, that if you were to bet 1/3 of your coins on any one trade, you go bankrupt every 8. Okay? And most people go bankrupt because they bet far too much on any one single trade. Now, the bet size is the difference between your entry point and your stop loss. Right? So if you buy a share at 10 Rand and you've got a stop loss at 8.50, if it falls from 10 to 8.50, that's the bet size. Okay? Am I correct, GT gentlemen? I think I am. So, unfortunately, there's a massive paradox here, because you do the fundamental analysis, you do the technical analysis, and you're sure the damn thing's going to go up, yeah? That's why you're putting the trade on in the first place. So, if you're sure it's going to go up, why not have a big bet? Let's accelerate the process of wealth accumulation. So you decide to trade far, far too big. And then, all of a sudden, you get a run of these bad ones. Now, if you don't believe me, here's what I want you to do tonight. Go to Monte Casino. Who goes to Monte Casino? Anybody? All right. You get to the casino tonight, lads. You go to the roulette wheel. It's a 50% game. Equal number of blacks and reds. And there's a little white ball, which is GT's cut. That's the house edge. Okay. And you look at the scoreboard down at the end, and you're going to see long runs of red and long runs of black. Those clusters are real. And it's this clustering effect that makes playing the game so difficult because you get long runs of good trades where you think you're God, and long runs, unfortunately, of bad ones where you feel like something that's under your shoe. Okay? Now, the first objective, ladies and gentlemen, is to live through the clusters arithmetically, that you don't go broke in them. Okay? Because you can quite easily have a cluster of 5 bad trades. Am I correct? Okay. Sure. 5 bad trades happen on a 50% system every 32. Alright? So if you were to bet 20% of your loot on any one particular trade, you go bankrupt every 5. And there is a big problem here. So there's a chap called Ralph Vince, and he's written a long series of books called Effective Portfolio Manager for Traders. Thick books. They've got them at Investec, they've got them at ABSA. But not bedtime reading, I assure you. And the gist of all of this is that you should not risk any more than 1 to 2% of your kitty on any one trade. So, if you've got 100,000 rand in your account, and you're new to this, you should not bet. You should not risk any more than 1 to 2% of that in any one trade. So the maximum loss, ladies and gentlemen, that you ever have on any one trade should never be more than 2,000 rand. And that will keep you alive. Okay. That will keep you alive. But there's a big problem, because we have runs of good ones and runs of bad ones. Now, between your ears, there's a thing called the pituitary gland. And that pituitary gland pumps out mutti. When I'm in England, I have to tell them what mutti means. But that pumps out all sorts of hormones into your bloodstream. And those hormones are actually responsible for every emotional state that you have. So, when you fell in love with that young lady of yours, those hormones were just pumping around your system. Alright? When I leave the gym, folks, I'm no longer 63, I'm 17 again and back in the Royal Marines, and as I say, can be quite stroppy when I leave the gym. Okay? Now, similarly, when you have one good trade, 2 good trades, 3 good trades, the pituitary gland is hard at work. Okay? And it's pumping this mutti into your bloodstream. And you change completely. I know people that after one good trade, they're a different person. Okay? Certainly after 2, after 3 winning trades, they're in the bar buying drinks and the souls have never bought a round in their life. What happens is that after a series of winning trades, we become euphoric. And if you look in the Oxford Dictionary, the definition of euphoria is invincible. So what happens is that you say, sod all that position sizing, let's have a big bet. And risk managers in the City of London are actually taught these days by the FCA to, in fact, that's the equivalent of the FSB here, to actually look at the traders under their control and assess their susceptibility to euphoria. Now, you're going to find that once you get the 1 or 2% into your head, it's in fact not the runs of bad trades that cause you to go broke, it's the run of good trades, because in a run of good trades, you actually trade far, far too big. So just be careful about euphoria. Now, our job is to find an edge in markets. Barry's analysis of all you need is one pattern. That's all. You just need one pattern to be successful. The head and shoulders pattern could be your pattern. He put a chart up of lots and lots and lots of patterns. I love my wedges, falling wedges and rising wedges. Those of you that are trading Forex, there's a textbook falling wedge in the euro, one daily chart at the moment. I'm very fond of my fib levels and harmonic patterns, which are my own personal edge in both the stock market and in the Forex market. But you need one little pattern. You need to practice really, really good money management, and that just means not losing any more than 1% of your loot, or at the very most 2% of your loot on any one trade. And then the third thing is to build the discipline to just do it over and over and over again. Many of you will see those ghastly adverts that Alan Gray put out. Do you know those long, boring adverts? Alan Gray are great. They've got a process that Alan Gray was taught by old Templeton a lifetime ago, and they do the same thing over and over and over and over again. I went to one of their lectures the other night in London, where it's Orbis across there, where they actually put on a case very similar to your case, where they justified fundamentally, based on value, that Honda was a much better buy than Tesla. Okay? Wonderful presentation, but they've got a process and they stick to that over and over and over and over again. And your process your trading edge does not have to be complicated at all. Finding a share that's undervalued, that's growing earnings aggressively and safely, that's in the throes of a good trend. I like always for a share to be above an 89-day moving average. 89 works for me. And then you need some little pattern to finesse the entry. It could be a triangle, could be an ascending triangle. There's a heap of them, and a simple book on charting will get you most of the way. And then don't lose any more than 1 or 2% in any one trade. And then you need to build the discipline. Now, ladies and gentlemen, can discipline be built, or is it God-given? Of course it can. Why was an old man like me in the gym this morning at 6:30? Why? Twice a day. Okay. Did it take any discipline to get me to the gym this morning? None. None whatsoever. The paradox is that when you've got it, you don't need it. Okay. All right. That's the paradox. So, to build discipline, folks, you're going to have to grit your teeth and stick to the process. So the first step would be to sit down with one of these guys, sit down with Bussy, put together your trading plan, a simple mechanical plan. The more mechanical, the better. Yeah. And then my challenge to you, folks, is to follow that plan without deviation for a batch of somewhere between 20 and 30 trades. That's going to take quite a bit of doing. It is a rite of passage. Now, I'm not a psychologist, and I've had psychologists in my classes, and they still don't know why this happens. But to build a habit, okay, any habit, you've got to grit your teeth and do it. And then all of a sudden, you actually build this neural pathway between your ears by doing it. You're going to find that sticking to the rules for the first few trades is difficult, but I've done this with many, many people over the years when I used to do one-on-one mentoring. I don't do it anymore. Somewhere between 5 and 13 trades, you build the pathway. And you'll find that the discipline to stick to the rules is no longer required. Because that's what you do. So my challenge to you all is, out of this, get busy, make a nuisance of yourself, get yourself to a point where you've got a written plan that suits you. It should not be more than 1 page. Think about position sizing. There's a good book on it by a guy called Van Tharp. It's called Trade Your Way to Financial Freedom on position sizing. And then the real exercise is to focus on perfect execution of that plan for somewhere between 5 and 20 trades. Now, I personally build a habit very easily. And many of you will say that's great, but it also means that you can build a bad habit very easily. So, the one thing that I can say which is positive, that everybody in this room is 8 to 13 trades away from the trader you want to be. That's all. But very few people get there because they don't adhere to the one system until that neural pathway is built. So that's the process if you want to be successful, folks. Sit down, put together a fairly simple system, adhere to 1 to 2% position sizing, and then the real work starts of being able to follow that system through thick and thin. And you're only about 8 to 13 trades away from being able to do that. That's all. Thank you very much. Any questions on that process? How am I for time, gentlemen?
No, you still have 15 years.
I still have?
15.
15? Okay. Any questions on that process?
Very good.
Yeah?
Sorry, just one. When we're limiting trades to 1 to 2%, can you have more than one concurrently running? Is that acceptable or not?
You certainly can have more than one running. I would suggest in the stock market that you don't have any more than 2 from the one sector of the market.
Sure.
Okay, and try and spread yourself across the market a little bit. I think that another thing which is quite useful is this probability matrix, because these are the runs of bad trades that I talked about. There's a 50-50 system. Now, if you're a pure trend follower with no fundamentals at all, just a pure trend follower, you're going to be right about 50% of the time. That's all. In fact, probably less. And there is the run of 4 bad trades in a row every 16. Now, by incorporating the fundamentals, folks, and pushing your hit rate up so that you're right 2 times out of 3, the cluster, you only have to handle 4 every 81 trades. And if you can get to a point where you're right 80% of the time, you've only got to handle a cluster of 4 every 625 trades. So, my advice to you is that when you're formulating your system, is that you do your best not to be trading all the time, but to be waiting to get 3 or 4 good trades in a month, so that you eliminate the clusters. And you can do that, as these gentlemen say, by putting together the fundamentals and the technicals. I think that trading technically alone is very difficult indeed, not because you can't make an awful lot of money, but because these clusters are really difficult to handle emotionally. Okay? After you've been wrong 5 times in a row, how good do you think you're going to be at putting your trading system into practice without fear or hesitation? It's going to be difficult. So, by adding the technicals and the fundamentals together, you can certainly push your hit rate up to this area where the clusters go away, and largely that's going to mean that you trade less. And for me, as I say, I want the share to be undervalued. I want the share to be growing earnings, and growing earnings strongly and safely. That's rising, and I don't like to buy into a share that's in fact under an 89-day moving average. Okay? And then I'm looking for a little pattern Triangles are great. Ascending triangles are great. Falling wedges are great. To finesse a good entry. And I want to be buying in when the general market is positive. And that normally means that I like the general market to be above a 21-day moving average. Okay? That it's rising. And that's a very simple little edge that I've been using for a very, 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 very long time that gets my hit rate up to around this area. I think that there's a book out there that you could be interested in, those of you that are new. It's a book by an old friend of mine called William James O'Neill. It's called How to Make Money in Stocks. The book is 25 years old. William O'Neill has got a history very similar to Vussi's here in that he started in the stock market as a junior in the New York stock market, and he then started his own brokerage company, and he's now got his own newspaper called Investors Business Daily. You can buy it at any newsstand in the US. So I think that you would find that book very useful for formulating your edge in markets. It's called How to Make Money in Stocks by William James O'Neill, Willie John O'Neill. Delightful old fellow. He's about 90 now. Okay. So don't complicate it. Really good fundamentals and a trend. Lots and lots of people, in my view, the Alan Gray methodology of deep value is wonderful if you're Alan Gray and you're buying a massive amount of shares. You've got no choice but to be buying in when there's a whole football stadium full of small people running away. That generates the liquidity for you to get in. But for most of us, we can get in just by pressing the button. Okay? So, great fundamentals, but the share must be going our way. And then a simple one, technical pattern such as some of the ones that Barry presented in that slide to try and get you in at a good place. So the market's going to go your way fairly quickly. And I also want the general market to be positive indeed. Certainly for the last month, it's not a time to be buying stocks when the general market is falling, unless you want to short stocks. It's not a time to be buying stocks when the general market is falling. So try and get those good fundamentals, a trend, a little pattern to finesse your entry, and then you want the general market to be going our way. And the most important thing, folks, is don't lose any more than 2% of your kitty on any one trade. That will keep you alive long enough to get good at this. Focus on perfect execution of the system. If you focus on the process of trading, the cash will take care of itself. You know, and think, you know that rich dentist that lives at the corner of your suburb? He's got an S500 and the wife's got a Porsche Cayenne, right? He's successful because he focuses on perfect execution of each and every root canal, each procedure. If he focuses on perfect execution of each procedure, his waiting room will be full and the cash will take care of itself. And similarly, your job, folks, is to have a plan and focus on the process of executing that plan over and over and over again. And if you focus on the process, the loot will take care of itself. The biggest hurdle that you have is to get over the first 8 trades. And if you can grit your teeth and stick to the process for 8 trades, something mystical happens between your ears. I don't understand it, but you build that neural pathway, and all of a sudden the discipline that you required is no longer required, because that's just what you do. The same as I assure you that when I get back to Lone Hill this afternoon, the first thing I'm going to do is to dust off the soot and go back to the gym. I have no idea why. I hope that you enjoyed the talk, folks. It's as close. I want everybody to be successful. I wish Finport all the very best of luck, and it's great pleasure and honor to be here. Thank you.